There's something very strange happening in crypto right now. On the surface, it doesn't look like much. Bitcoin is sitting in a range, retail interest is weak, people are getting impatient. The market isn't giving investors the explosive moves they've been waiting for. And if you spend enough time on crypto Twitter, you can almost convince yourself that nothing's happening. But underneath that boring price action, several things are actually moving at the same time. The Senate is finally moving forward on the Clarity Act after weeks of delays. Momentum indicators are flashing signals that haven't appeared in years. Bitcoin whales and sharks are accumulating while smaller holders are reducing their exposure. Altcoins are showing bullish divergences on higher timeframes. And outside the United States, Russia has now moved forward with its own crypto market structure legislation. So the question isn't simply, why isn't crypto going up? The more interesting question is, what if the market is building the foundation for the next move while most people are watching the price? Because historically, some of the most important phases of a market don't feel exciting while you're living through them. They feel boring, they feel frustrating, and sometimes they feel completely disconnected from what the fundamentals are telling you. Today, we're going to connect all of these pieces, because there is a bigger story developing here. Before we get into it, this video is for educational and informational purposes only. Nothing in this video is financial advice, and nothing here should be interpreted as a recommendation to buy, sell, or hold any cryptocurrency. Always do your own research before making any financial decisions. Welcome back to Ledger Pulse. Today we're looking at something I think is becoming increasingly important for the crypto market. The difference between what the market feels like right now and what the underlying structure may actually be telling us. Because if you only look at price, this market can feel incredibly frustrating. But when you zoom out, we're seeing developments across regulation, market structure, liquidity, accumulation, technical momentum, and even international competition. Let's start with the biggest immediate development. The Senate is finally moving forward on the Clarity Act. Here from BankXRP, Senate Majority Leader John Thune is filing cloture on the motion to proceed with the Clarity Act, albeit after August recess. This is pretty significant because we've spent weeks watching uncertainty build around this legislation. And that's worth emphasizing. The story hasn't simply been the Clarity Act is eventually going to pass. There's been genuine uncertainty surrounding the timeline. We've seen delays, we've seen disagreements, political pressure, and we've seen the banking industry push back against provisions that could create more competition. And now we're seeing Senate actually move procedurally. That doesn't mean the legislation is guaranteed to become law. It doesn't mean every obstacle has disappeared. And it certainly doesn't mean the crypto market has to immediately rally because of this development. But there is a difference between talking about legislation and moving legislation through the process. That's where we are now. And that's important for understanding the market, because regulatory clarity isn't really about creating a one-day pump. It's about creating an environment where companies can make long-term decisions. Imagine you're a financial institution. You want to offer digital asset services. You want to build custody infrastructure. You want to tokenize assets. You want to create payment products. You want to connect traditional finance with blockchain networks. One of the biggest questions you're going to ask is, what are the rules? Not what will Bitcoin do tomorrow, but will this business model still be legal and economically viable 3 years from now? That's the type of uncertainty regulation can address. And that is why the Clarity Act continues to matter even if the market isn't immediately rewarding the headline. There's another post that adds an interesting layer. A post from Brendan Peterson highlights Senators Cynthia Lummis and Bernie Moreno have become co-sponsors of the Credit Card Competition Act. Eleanor Terrick comes in and says that it's a piece of legislation that the banks hate because it would introduce more competition to credit card processing and threaten their swipe fee revenue. Nothing to do with Clarity Act directly, but you can probably read the timing as a shot across the bow at the banks for helping derail the Clarity timeline. Her argument is essentially that the disagreement isn't necessarily about crypto itself. It's about competition, and that's a much bigger conversation, because crypto regulation isn't happening in a vacuum. There are enormous existing financial businesses that have operated under established rules for decades. Then, blockchain technology comes along and says, what if settlement could become faster? What if payments could operate continuously? What if assets could become programmable? What if custody could be handled differently? What if financial markets could operate on infrastructure that doesn't necessarily follow the traditional banking schedule? Those aren't just crypto questions. They're questions about the future architecture of finance. And whenever new infrastructure threatens an established business model, resistance is almost inevitable. That's why I think it's a mistake to look at regulatory delays and conclude that crypto is somehow failing. Sometimes the opposite is true. The more disruptive the technology becomes, the more intensely the existing system may fight over how it's integrated. That's exactly what we're watching unfold. Now let's address the other side of the argument. One post here from Matthew Hyland says that the Clarity Act doesn't matter. Macro risk cycle does. And while I wouldn't go as far as saying that the Clarity Act doesn't matter, there is a legitimate point here. Markets don't trade fundamentals in isolation. They trade liquidity, they trade risk appetite, interest rates, economic expectations, they trade positioning, and they trade fear and greed. And that's why we can have a major regulatory development happening while Bitcoin barely reacts. The market can essentially say, that's good news, but we're not ready to price it in yet. Imagine a company announces that it's building a massive new factory. That's potentially bullish for the company's future. But if investors are simultaneously worried about a recession, high borrowing costs, and weak consumer demand, the stock might not immediately explode higher. Cryptos work in the same way. You can have improving infrastructure while the macro environment is still creating resistance. And that brings us to something much more interesting, because we're starting to see signs that the broader market cycle may be changing. A momentum indicator for the business cycle has apparently flipped positive for the first time in 6 years. And the chart is particularly interesting because previous positive transitions were followed by major crypto moves. Now we have to be careful here. A technical indicator is not a crystal ball. Markets don't repeat perfectly, and a signal that worked historically doesn't guarantee the same result today. But what does make this interesting is the duration. 6 years is a long time. We're not talking about a small, short-term oscillator turning positive for a few days. We're talking about a broader cycle signal changing direction. And if the underlying business cycle is transitioning toward a more favorable environment, crypto could eventually benefit from that change. The difficult part is timing. Markets can recognize a trend change long before prices respond dramatically. That's why these periods can be so frustrating. You can have the indicator, you can have the improving fundamentals, you can have institutional adoption, you can have regulatory progress, and yet price still moves sideways for weeks or months. And that's where investors often make their biggest mistake. They assume that because the price hasn't moved yet, the thesis must be wrong. But sometimes the market simply hasn't reached the part of the cycle where the underlying improvements get reflected in price. This is where the Bloomberg ETF commentary from Eric Balchunas becomes relevant. The post highlights his view that doing nothing may be the most reliable investing alpha because ignoring market noise can outperform constant trading. And this sounds almost too simple, but it's incredibly relevant to crypto because crypto markets are designed to keep you engaged. Every 5 minutes, there's a new headline. A well-moved Bitcoin, an ETF had inflows, a politician said something, a senator changed their position, a token pumped 12%, another one crashed 18%, someone predicts $500,000 Bitcoin, someone else predicts a 50% crash. And if you respond to every headline, you're essentially allowing the market to dictate your behavior. That's exhausting. And more importantly, it can be expensive, because the best opportunities don't always come with fireworks. Sometimes the opportunities look like Bitcoin moving sideways, XRP moving sideways, Ethereum moving sideways, altcoins looking terrible, retail losing interest, everyone asking when the next bull run is going to start. That's not necessarily a bearish environment. Sometimes that's just what accumulation looks like. The market has to transfer coins from the impatient holders to the patient holders, and that's exactly what another post is suggesting. Santiment's update is one of the more interesting pieces in today's episode. According to the post, Bitcoin whales and sharks are adding more and more BTC to their wallets around the $63,000 to $65,000 area. Meanwhile, smaller holders are showing their sharpest decline in holdings since September 2024. Think about that. One group is reducing exposure. Another group is increasing exposure. That creates a very different market dynamic than simply saying Bitcoin is down, because the question becomes, who's selling to whom? Markets are ultimately about transfers of ownership. If weak hands are selling and stronger hands are accumulating, the market can be going through a redistribution phase. That doesn't guarantee a rally, but it can create the conditions for one. And there's another factor mentioned in the post. The cold card related hacks and the broader uncertainty surrounding crypto have contributed to smaller holders becoming more cautious. Then add stagnant prices, add the uncertainty around legislation, the lack of excitement, and you get something interesting: retail capitulation without necessarily seeing institutional capitulation. That's a very different environment from a market where everyone is aggressively buying. Let's think about this from a psychological perspective. Imagine you bought Bitcoin because you believed it was going higher. Then it doesn't go higher. It goes sideways for weeks, maybe months. Eventually, you just get tired. You start asking, why am I holding this? You see stocks doing something else. You see another token briefly pump. You see someone online claiming the bull market is over. Eventually, you sell, and someone else buys your position. If that process continues long enough, the market can gradually become dominated by holders who are less willing to sell. That's one reason long periods of consolidation can matter. The market isn't necessarily doing nothing. It can be changing its ownership structure. And this is why I wouldn't automatically interpret boring price action as a negative. Sometimes boring is the process. The explosive move is the result. Now, let's talk about the Bitcoin MACD comparison posted by Blockchain Backer. The post compares the current monthly MACD environment with 2022. The basic argument is that a major monthly momentum transition previously occurred around a significant market bottom, and the implication is that we're potentially approaching another major inflection point. That's pretty fascinating, but again, we have to separate historic similarity from guaranteed repetition. 2022 was an extraordinary year. FTX collapsed, Bitcoin experienced enormous forced selling, and the broader macro environment was completely different. So we're not living through the exact same circumstances, but the reason these comparisons are useful is because it can help us recognize market behavior. Markets often move through phases: expansion, momentum, distribution, decline, capitulation, accumulation, recovery, then expansion again. The exact catalyst changes, the participants change, the technology changes, but human behavior doesn't change nearly as quickly. Fear still causes selling. Boredom still causes selling. Greed still causes chasing, and that cycle repeats. So when a long-term momentum indicator begins approaching a historically significant transition, it's worth paying attention to. Not because it tells us exactly where Bitcoin will be next month, but because it tells us the market may be approaching a different phase. Now we get to one of the more encouraging signals. Michael Vanderpop points to what he describes as bullish divergences across altcoins, and he makes a very important observation. The signals are appearing on a higher time frame. That means patience may be required. This is something that gets lost in crypto constantly. A bullish divergence doesn't mean altcoins are going to pump tomorrow. It means momentum may be weakening on the downside even while price hasn't fully reflected that change. Think of it like pushing a heavy object uphill. The object may still be moving backward, but the force pushing it backward is becoming weaker. Eventually, you reach the point where the direction changes. That's the basic idea behind a bullish divergence. And if we're seeing several of these signals across higher timeframes, it could mean the market is quietly becoming healthier beneath the surface. But once again, timing is the difficult part. A market can remain undervalued longer than anyone expects. That's why these indicators are better used as pieces of a larger framework rather than standalone predictions. Now let's step outside the United States. Here we have a post reporting that Russian President Vladimir Putin signed crypto market structure legislation into law. It represents another example of governments moving toward formal frameworks for digital assets rather than simply pretending the technology doesn't exist. And this is becoming one of the bigger stories in crypto. Governments don't spend enormous amounts of time creating legal frameworks around technologies they believe are irrelevant. They regulate things because those things matter. And this creates a global competition. The United States is figuring out its regulatory framework. Europe has been developing its own approach. Asia has been building digital asset infrastructure. The Middle East has been aggressively positioning itself as a financial technology hub. And now we're seeing Russia move further into formal crypto market regulation. That doesn't mean every country will have the same strategy. They won't. But it does show something very important. Digital assets are becoming part of the global financial conversation. And this brings us to XRP, because when we talk about regulatory clarity, institutional infrastructure, and global financial integration, XRP sits directly in the middle of that conversation. The bullish case for XRP has never simply been XRP might go up because crypto goes up. The more interesting thesis is what happens if blockchain infrastructure becomes increasingly integrated into traditional financial systems. If banks, payment providers, asset managers, and other financial institutions increasingly use blockchain-based infrastructure, then the value proposition shifts. We're no longer talking exclusively about speculation. We're talking about settlement, liquidity, cross-border payments, tokenized assets, institutional custody, and interoperability between traditional finance and digital networks. That's why regulatory clarity matters so much for assets like XRP. You don't necessarily need every institution on Earth to suddenly start buying XRP. You need the regulatory environment to become predictable enough that institutions can confidently experiment, build, and deploy. That's a much longer-term thesis, and it's also why short-term price action can be misleading. The infrastructure can advance while the token price barely moves. Those two things don't always happen simultaneously. This is where I think these posts start to connect. Look at what we have. The Clarity Act is moving forward. The regulatory debate is intensifying because there's real economic competition involved. A business cycle momentum indicator has reportedly turned positive after years. Bitcoin whales and sharks are accumulating. Smaller holders are reducing exposure. Bitcoin's longer-term momentum indicators are approaching historically significant territory. Altcoins are showing higher timeframe bullish divergences, and other countries are moving toward formal crypto frameworks. Yet the market still feels boring. That creates an interesting possibility. Maybe the market isn't ignoring the fundamentals. Maybe it's waiting for confirmation. That's a huge difference. Investors don't necessarily want to be the first ones to buy. They want to see evidence. They want to see the breakout. They want to see the legislation, the liquidity. They want to see Bitcoin reclaim certain levels. They want to see altcoins move. And by the time all those things happen, the market may already be significantly higher. That's the paradox. The period when the evidence is strongest is often the period when the risk-reward has already changed. Now, I don't want this episode to turn into a blind bullish prediction. There are very real risks. The Clarity Act could face additional political obstacles. Macro conditions could deteriorate. Bitcoin could break lower. The accumulation data could simply reflect temporary positioning. Technical indicators can fail, altcoin divergences can remain unresolved, and global regulation can move in contradictory directions. There's also the possibility that the market needs much more time. That's the part nobody likes hearing, but it's important. A bullish setup doesn't mean an immediate rally. It means the ingredients for a rally may be improving. Those are two very different statements. And that's why I think the best way to approach this market is to stop obsessing over a single prediction. Instead, watch the signals. Is regulatory clarity improving? Is institutional infrastructure expanding? Are long-term holders accumulating? Is liquidity improving? If enough of those variables turn in the same direction, the probability of a larger move increases. And here's the part I think could become especially interesting. The market is currently giving people plenty of reasons to be impatient. That's exactly what you would expect during a prolonged consolidation. People want action. They want confirmation. They want a breakout. They want Bitcoin to immediately start making new highs. But markets don't owe us that confirmation in advance. Eventually something changes. Maybe it's macro. Maybe it's regulation. Maybe it's liquidity. Maybe it's institutional demand. Maybe it's simply a technical breakout that triggers a wave of momentum. Once that happens, the psychology can change incredibly quickly. The same people who were saying crypto is dead can suddenly start saying, I knew this was going to happen. And the people who spent months accumulating quietly may suddenly look like geniuses. That's what's strange about markets. The narrative changes after the price changes, not before. So let's zoom all the way out. The most important thing happening in crypto right now is not the price action. The bigger story is that the financial system continues to move toward blockchain infrastructure. Governments are writing rules. Financial institutions are building products. Market participants are accumulating. Technical indicators are beginning to change. And the regulatory debate is becoming more intense precisely because there is more money and more competition involved. So right now, crypto may look boring. It may feel slow. It may feel frustrating. And there are plenty of reasons to question whether the next major move is actually coming. But underneath that surface, there are several signals worth watching. The story is still developing, and sometimes the biggest moves begin during the periods when almost nobody feels like waiting around for them. That's why I'm watching the infrastructure. the regulation, the liquidity, and the long-term market structure, not just the green or red candle. Because if the underlying environment is changing, the price eventually has to respond. The question is simply when. If you enjoyed this breakdown, hit the like button, it really helps the channel. And let me know in the comments, do you think we're looking at the final stages of consolidation before the next major move, or does crypto still have more downside ahead? And if you want to make sure that you're up to date with what's happening in crypto, make sure you're subscribed to Ledger Pulse. I'll see you in the next one.